So our first conversation this morning, and it is a conversation, it's one we hope you'll participate with in the form of questions. I'll open it up to your questions, is with one of the folks who helps set the agenda for what you do and where your businesses may go. Neville Henderson is Assistant Superintendent at OSFI, but he has, as you probably know, spent his career on both sides of this street. He spent many years, decades, in the industry. He spent time as a senior partner at PricewaterhouseCoopers, and now as a regulator. What occurred to me as I looked at his history was that old sitcom, Mad About You. I don't know if you remember that. The Millennials won't. But there was a great line in it when the woman, Jamie, said to her husband about her mother. She was complaining, "Why does she always manage to push my buttons?" And her husband, Paul, said, "It's because she installed them." That's a little bit like what a regulator like this can do. He knows where the buttons are because he played on that side. He knows what you want, he knows what you need, and he's not always going to give it to you. Neville Henderson is going to join me now on stage. Please join me in welcoming him to the stage. Neville? Thank you.
My pleasure. Hey, bonjour à tous.
That's the end of the French, by the way.
Would you like some water?
No, thank you.
Yeah.
That's very kind of you. So I want to start with just kind of a broad question about what you're thinking.
My thinking.
You've got a room full of leaders from the industry in various different segments of the industry. So just kind of areas of concern and focus for OSFI that you would share with this room, top of mind for you. I know you've talked in the past about long-term versus short-term thinking, risk management. What are the top areas?
Right now, we're really concerned about catastrophe coverage and reinsurance. Recent events are getting increasingly more common. They'll fluctuate over the years, but there is clearly a trend, and that is a big concern to us. Over the years, we've been taking a look at reinsurance activity, and reinsurance is extremely important in managing catastrophe risk. And we found that we don't have a deep understanding of how some of that's done, how it might concentrate risk. So we're looking very closely at reinsurance practices. We want to understand that somewhat better. So there's a lot of work going on that end. IFRS accounting standards are coming into play. They will have a significant effect on the industry. We want to make sure the industry is prepared. We have established our capital requirements, and we have concerns that some of the changes may affect capital, and we don't want that to happen. So we are paying close attention to what happens with the introduction of IFRS in case we have to respond to it and change our capital requirements. Cyber risk is constant. I spent a better part of a week in Oslo talking to companies about, or other regulators about cyber risk and what's happening. And it's not a P&C industry issue. It's not a life insurance issue. It's an every company issue. It's an every country issue. So a lot is going on. The reality is when we think we've got some solutions, someone finds a way of breaking around them. And it's a constantly changing environment. So there's a lot of work to be done in that area. So those are some of the issues, but we could go on for a long time talking.
Well, let's drill down a little bit. When you talk about reinsurance, because that is obviously the key de-risking for the industry, for the world. What are the issues that you're looking at in terms of what you'd like to see to protect us, especially as it pertains to catastrophes?
Well, we strongly encourage companies themselves to take a look at their reinsurance protection, but we want them to look at it in the context of their business. So we want them to do significant stress testing on their business, understand their vulnerability, and use reinsurance effectively to protect them. They need to understand when they buy reinsurance what their counterparty risk is going to be, which means that they need to have some deeper understanding of how reinsurance operates. And what our finding has been over the years is that many of the companies really don't know what the counterparty risk is. There have been forms of reinsurance that tend to concentrate that risk. So we're trying to get our handle on how much that concentration is and what effect it might have in a severely adverse catastrophic event. So there is a lot going on in that area. And We expect and are in a process of bringing out a paper for discussion with the industry, probably take place early next year. We're having discussions at executive level in OSFI later on this year. But it'll talk to many of the issues we've uncovered. There will be some recommended changes. One of the things we've found is that companies don't really understand some of the guidance, so they're not following it. So some of it's just clarification. That's going to happen anyway, and likely there won't be very much input from the industry on that. Some of the other elements get into changes that might affect capital, and we need to have discussions with the industry on those, find out if there are any undue or unexpected implications from that. And there are some other areas where we just don't have the detail, and we need to get that detail. So we're going to be asking the industry to help us to get it pulled together and figure out how we respond to it from a regulatory and supervisory perspective.
How much of what you're thinking these days takes you to questions about global regulations? In other words, how we cooperate with other jurisdictions to make, because obviously counterparty risk crosses borders.
Yes, it does. And we do have a lot of interaction. I think, gosh, this year I've been in Paris, London, Oslo. I've got trips to Basel. I actually had some trips to Basel. And we talk constantly about these issues. There is a lot of commonality. Things like cyber risk, for example, it's everyone's problem, and it's pretty similar everywhere. None of us really know how to deal with it. But we do spend a lot of time talking about those issues and determining whether we can actually work together to help come up with solutions that are more effective. So we spend a great deal of time. There are a lot of companies that have international, either their parents are foreign or some of the Canadian conglomerates are international companies. So we need to understand what's happening internationally. When we draft our regulation, we don't want to make it conflict with other jurisdictions, for one thing. And to the extent that we can make it similar and effective, that should be our option. On the other hand, we can learn from international regulators. Some of the technical things they've done, the advancements in financial mathematics, have helped us with revamping of our life insurance capital requirements. So a lot of positive advantages. On the other hand, there's some things they're doing that we don't really think we want to do. And we stand our ground on those. We will present our case, and if we don't think it's appropriate for Canada, we don't do it.
You mentioned catastrophic losses. In terms of, I mean, one of the things that really jumped out at me recently was that at this conference for the last 7 years, there's been a real, I mean, I don't want to say preoccupation, but preoccupation comes to mind with flood and earthquake. And yet, for lay people, that's really only been a kind of a last, I don't know, 8 months kind of conversation where we're sort of thinking, where's our insurance on this? Mm-hmm. Where should the regulator be on making sure that the uninsured are insured? I mean, what's the role for policymakers to play so that we're prepared for what may be an increasing occurrence?
That is a challenging question. And we've known for many years there's a huge coverage gap in certain areas. And many of those are actually controlled by municipalities, building codes, allowing housing construction to go in flood zones, and no requirements for coverage. From an OSFI perspective, our mandate is very, very clear, and we are there to protect policyholders, depositors, and other creditors from significant financial loss. So it doesn't mean guarantee no insolvencies, it just means protect them from significant financial loss. So we actually don't have any say in coverage or mandating and requiring coverage. Now, we do deal with the Department of Finance, and 4 times a year we have committee meetings with them, and we talk about issues within the industry. They, of course, are the policymakers, and they will ask us what the implications are of certain events. And we do a lot of stress testing, either that or we actually have companies do stress testing, and we pull it together, and we'll talk to them about the potential issues and cost of those shortfalls, because ultimately some of it's going to fall on the taxpayer. And there is concern about that. So earthquake coverage is one where we've actually done a great deal of stress testing and presented results. And I think there's significant concern about the potential impact of that. But I guess when you're in directly making policy, rather than worry about a 1 in 500 year event, you're probably worried about stuff that's going to happen tomorrow and could hurt the economy. So it is a challenge for them, but it is a very real issue. Earthquakes, far more rare than flooding and winter storms. Those seem to be constant, and all of the indications from carbon testing and scientific testing is that these things are going to get worse, not better.
You know, you've talked in the past publicly about a real kind of call to the industry to think long-term, to prepare for the long-term and not get caught in short-term thinking, which is, you know, in this world, especially in public markets, easy to do. But the other piece that you're mentioning here of this three-legged stool, if we think of industry and regulator and politicians, politicians also, by necessity, think short-term. They want to be reelected. So you kind of play an interesting role in that you're the only one who can afford to think long-term. How do you influence the politicians to be with you?
That's a good question. And we actually, our mandate, it prohibits us from advocating. So we can raise issues, and we do that. Automobile insurance is a perfect example. That's outside of our control, really. That's largely provincial. But it's creating some very significant financial and prudential issues for companies that are heavily into that line of business. So we are very concerned about that. There's only so much the companies can do when you artificially restrict their premiums. And so we deal with the provinces, we talk to them, we talk to federal, the Department of Finance about those issues. We try to encourage change, but we really don't have any control over it. Our function is to make sure that companies have enough capital to pay their policyholders. So our job is really policyholder oriented. Even similar jobs, for example, we were asked by some of the provinces to do their financial work on insurance companies, really small insurance companies, but that's outside our mandate. We were prohibited from doing that. So there's some interesting challenges that we face, but our mandate is very limiting in what we do. It gives us tremendous power in doing it, but it's very limiting in our perspective.
You are, by nature, you're in a role that requires you to consider risks and be, I suppose, take a glass half empty point of view, at least when it comes to how things might unfold. Are you generally optimistic about how well capitalized our industry is here, how it's functioning, how the regulations are playing out at various levels?
Overall capitalization in the industry is good. There are always problem companies, but it is strong at this point. We do have concerns about growing trends in weather-related events. So we monitor those closely, but the industry responds to it, and we'll find solutions to that. I do find that the industry itself is very forward-looking. We're in insurance, and our job is to look through the crystal ball and look for opportunities. And I think this industry does that very, very well. So we do look forward, but there are issues out there that might catch us, and we are constantly reviewing our capital requirements. We constantly ask companies to provide stress testing so we can get a sense for how certain changes might affect them. So we do look out well into the future to understand what's going on. And it's one of the reasons we developed the ORSA technique for companies so that they could do their own stress testing on their product portfolios and understand the risks that are inherent in their business, do stress testing and see where that might take them if the environment changes or if circumstances change. So I think we get a very good forward-looking perspective on the industry and have no immediate concerns.
And on those own risk assessments, are you generally happy with what you see? It's being done in a way that you think is credible and as rigorous as intended?
Yeah, we don't ask to, when we initially started with it, we didn't make it mandatory. It had to be submitted to us, those reports. We did look at them initially. There were some issues. Some companies took it as being just a requirement, and so they didactically went through the calculations. But we're finding that ORSA now, companies are really recognizing the importance. There's still some that don't see it that way, but by and large, it's very well used. Companies see it as quite a valuable tool. We don't use it specifically, although with IFRS coming in, I'm starting to wonder whether we might have to start changing that approach. Right now, we depend more heavily on dynamic capital adequacy testing and a lot of our significant activity reviews to get a sense for risk in the company. Dynamic capital adequacy testing does look out a few years, so we get a sense for what could be happening. Companies do stress test that as well, so we get a sense from that what could affect them. So I think we've got a good forward look on the industry, and we're continuing to change. One of the issues that's going on right now is whether we need both DCAT and ORSA, or whether we should integrate them, and that's being worked on with the Canadian Institute of Actuaries, because there are implications from a professional perspective. So there is a lot more change going on in the industry. We always hear about the change that causes pain in work, but this one actually will decrease it. So hopefully something happens there to change that approach.
Yeah, and you mentioned IFRS will change some of your approach. In what way do you mean it will change it?
Well, it's going to change accounting standards, so it's going to have a significant effect on the income statement, balance sheet, and disclosures. On the P&C side, it's not quite as bad as it is on the life side. On the life insurance side, it's going to have could have some very, very significant effects, especially on reserving and capital requirements. So from OSFI's perspective, well, from the industry's perspective, it's just a huge amount of work, because they're going to have to change a lot of systems, their feeds, virtually all of their data is going to be changed to some degree. So that work is already starting, and we're working closely with the industry because we want to understand the implications. What we don't want to have happen is that the accounting changes cause companies to have to increase their capital or decrease their capital. We think we've got the right capital in place. So we may have to look at how we undo some of the things that the accounting change does. So there'll be some interesting challenges ahead on IFRS. It's supposed to go in I guess it's 2020, but there's a year of transition starting in 2019. So that whole year is going to be, well, it's getting pretty close. We got another year to go. So there's a lot of work to be done in that period of time. Meanwhile,
there are all kinds of technological innovations happening, some of which are being used by the industry already to make their businesses better and more efficient, some of which are kind of game-changing in terms of how consumers interface with this industry. How do you stay abreast of what you need to know so that you don't become like the taxi regulator, kind of, closing the barn door after the horse is out?
Yeah, that's a tough question. We do what we call significant activity reviews. We constantly monitor the industry. We also have internal committees that take a look at emerging issues. So we constantly are reviewing materials. We learn from the companies. We attend and participate in sessions like this. We have a pretty open relationship with the industry. If we want to change something, we discuss it with them. If it has negative implications we hadn't thought of, we change what we do. And we find the industry itself is an important source. When you read newspaper articles, they often talk about it being a sleepy industry, but really it's not at all. It's probably the problem with it is it's complex, and people don't want to understand the complexity. But it is a very dynamic industry. It changes constantly. So we do have the mechanisms to stay on top of changes. A lot of our international activity actually moves in that direction as well. Things that are happening abroad happen here. So demutualizations, for example, took place in Europe, and then all of a sudden all of Canada demutualized their companies.
Right.
So there is that sequencing. So by staying abreast of what's happening internationally, staying in close contact with organizations and with the industry, that's how we keep on top of it.
I always say that in every panel there's a moment when the media gets trashed, and I wait for it. So we've had it. The media gets the industry wrong. Thank you. We can move on now. I have a question about millennials, but I also want to just put it out to the room here. I think we have microphone runners in the room. I may be making that up, but I think we do. And if you raise your hand, yes, if you raise your hand or stand up, somebody will bring you a microphone. So I'll just start by asking, do we have any questions at this moment? Anyone? Okay. When I see you standing, I'll come out to you and you can ask a question. We are seeing shifts in behavior in other industries. Millennials behave differently around ownership of things. They may never own a car. They may never want to own a house, so we're told. How will what's your thinking around how the regulator has to kind of evolve if we get a whole generation of people that behave differently?
We will respond to how the industry behaves, to be honest with you. And the industry is well aware of those changes. Gosh, back in even the 1990s, I had helped companies set up websites to deal with new clients, advertised products. They actually did some simplified underwriting, accepted business. So it's been out there. But the industry itself, especially the life industry, is heavily dependent on distribution, and that's a key element across insurance. So in order to avoid disruption of the distribution system, it's been slow. But my sense is the companies are aware of the issue. They recognize what the conflicts are likely to be. I think they're well prepared to move ahead with Millennials and take them on. If they want to do it on an automated basis through their computer, then they will be able to do that. The issues with cars and the sharing economy, those are quite different. The industry has started to address those, and we do have some issues with that. But they're healthy things to do. We've got a changing world, a changing environment, and the industry has to respond to it. That's what creates their market. So they're taking on new things. Cyber risk is an example. Companies are insuring that. There's no experience. Some of the cyber costs can be gargantuan. So we monitor what they do there very closely. So their pricing is an aspect. With no experience, it's hard to know what that would be. So, you want adequate margins in it. They need to set up their contracts and their provisions so that they control their risk. They need to do appropriate stress testing to make sure that if things go awry, they can stop sales or do whatever they need to do to preserve capital and stay solvent. There are issues with all of these developments, but there are also a lot of opportunities, and that's the way it's going to be in the future. And ever since insurance has been around, the industry has accommodated or addressed those changing issues. So I've only been at a little over, well, I won't say how long, but it's a long time. And I've seen continuous change. At one point we thought it would never change as much as it has, and it just continues to go. And I tend to be someone who bores easily, so I find this industry is really fascinating. It's just
in terms of some new technologies, one really interesting example of a technology that has broad implications for this industry are autonomous cars. I'm told you love autonomous cars. You can't wait to get into one.
Gosh. Yeah, they're a big issue. And there's a lot of nonsense around how effective they are and all this sort of stuff. There's a lot of work that needs to be done on autonomous cars.
He doesn't love autonomous cars, if you can't tell.
But I personally drive an SL63 AMG, and I had Brabus do some work.
I don't know what that is.
That's a Mercedes sports car,
Okay.
and I love that sucker. And there is no way I'm going to get into an autonomous car. I pray every night those buggers fail in developing those things.
But for de-risking our lives, presumably a car driven by an intelligent machine is better than a car driven by any one of us. Even you.
No, I don't buy it. But anyway, and I think, when you get into it, there's a lot of technology issues. Even now when you use GPS, and even my Mercedes, I'll go down one street, it tells me to turn right, and I'll say, pull a U-turn. And of course I have a German car, so it's "you Dummkopf." But so it's an interesting phenomenon. The technology doesn't work all that well. There are shortfalls in it. Certainly when you get millions of cars on the road and they're all operated by the satellites, what happens when you've got a major storm, thunderstorm in particular? Cyber risk is a big issue right now. If someone really wanted to cause economic problems, it'd be easy to create a mess in that industry. So I think it's a very high-risk industry. This is one area we talked about mandating coverages. Automated cars don't work that well when you've got thinking drivers, human-driven cars. There's lots of conflict, and they don't know how to respond. So one of the solutions might be to mandate driverless cars. And when that day comes, I hope I'm long gone.
I don't know if you've seen the new Lexus commercials, but there's actually a commercial aimed at this kind of fondness for when you used to drive your own car, and now you've got to be driven around. It's appealing exactly to people like you who love your car. You mentioned actually something that this security expert mentioned to me a couple weeks ago, and that is the GPS system. I hadn't realized that the GPS system is completely hackable, and there's no backup plan. There are 3 such global systems and none of them rely on one another. So if GPS went down, is that the kind of thing that the insurance industry needs to be thinking about? Like where, I don't know where the liability would fall if GPS went down and people drove off cliffs.
Yeah, I think there are huge opportunities with it for the industry. Notwithstanding my personal dislike of automated cars, there are huge opportunities, and I think the industry will find them, and that is certainly one of them. Some of the cars, I think automobile manufacturers, I think Telsa and Volkswagen, I believe Mercedes has said as well, they're going to offer insurance on their vehicles. It's not sure what they're going to insure, whether it's their technology, the car, or whatever, but there are going to be big questions about who gets the insurance, whether it's who's insured, whether it's the manufacturer who's insured, or the owner of the car who's insured. There are all sorts of question marks around coverage going forward. My sense is there'll be tremendous opportunities for the insurance industry. They may actually be the carriers of the coverage. These insurance companies may just decide to outsource it. And of course, we have guidance on how to do that. So, you know, we're in a way prepared for some of that, but we expect that's what will happen. I think it's going to create huge opportunities for the insurance industry going forward. It's just a matter of finding how to apply them.
And is it, I mean, kind of back to this, this coverage gap, is it the role of, whether it's regulators or other policymakers like lawmakers, to insist on coverage, or do you let the industry lead and explore how that works?
I think the industry has to push that. It's not our responsibility, of course, and we are to some well, there are a lot of restrictions on what we do and who we talk to and what we say. So we have to be careful in that regard. But really, the industry should be talking to Parliament and to the representatives and getting the points across. There are also a lot of issues that need to be addressed with municipalities. You know, building codes could be stronger to prevent houses blowing apart. And you see things on television showing how, you know, metal straps attaching the roof could prevent huge amounts of damage, and they're fairly inexpensive. So there's a lot of things that needs to be changed. I can understand the industry's frustration, however, because you're dealing with bureaucrats, and sometimes it's very difficult to get those things to happen in a timely fashion. But there is a lot that needs to be done to improve circumstances and better control risks.
And of course, when it comes to things like flood, parts of that equation are municipal governments with overtaxed systems in every sense of the word, and an inability to update infrastructure. What's the push-pull there? Because a homeowner wants protection, but the weakest link may be the municipal sewer system outside of his house.
Yeah, I don't know what the weakest link is in that one, to be honest with you. You know, the industry makes people aware that they need flood coverage in certain areas. In some instances, the industry won't offer flood coverage if it's a high probability zone. Either that or the price is prohibitive. So there are big issues in allowing people to build in flood zones. The coverage just plain may not be available. So there needs to be, you know, municipalities need to be alerted to the issues that they're facing. And when these disasters happen, it's the municipality that ends up cleaning up the mess.
But where should the pressure come? Because I'm not sure that policyholders truly always understand that it isn't the industry, that the gap is actually with their government, and their own tax dollars need to invest in infrastructure or building in a different way or in building codes or whatever it is. Where does the education piece happen?
I think it happens from the industry, and I think they have to alert, well, municipalities do it, but also policyholders. Yeah. And they, you know, quite frankly, they do a lot of disclosure. I find there's so much of it that sometimes people don't read it. So it's not that it doesn't exist. It's just it may be how effective it is. It may be that people don't want to read it. You can't be bothered, you know. But it is a real challenge. But it is up to the industry to really get those points across to the municipalities and to the regulators, or not the regulators, but the policymakers.
There are a series of guidelines that may be changing as you go ahead. What are some of the things you are looking at that you may be consulting on and may bring new regulations around, things like RSA or capital requirements?
Yeah, well, RSA falls under our reinsurance review. There's some changes there we're contemplating. Same with B3. We've got some changes that we're contemplating on that. Some of those are really just clarifications, so my sense is that there'll be no issue with those. Some of them will have some industry implications, so we're going to discuss those with the industry before we finally implement them. So you can expect to see change. Those two documents probably will have some changes. There are a number of other issues that we need to talk over with the industry and get a better sense for how significant the risk might be. So that we'll have that discussion with them. IFRS changes are going to generate more work. One of the issues companies are probably interested in what's happening to our guideline around the chief agent. We actually were pretty close to having that finished a year ago almost, and put it on hold because we started a review of board requirements. And what we've found is that we've got board requirements in so many documents, they don't necessarily conflict, but it's very confusing for the reader and for boards to stay on top of everything that's going on. So we've actually been pulling all that stuff together and trying to simplify it. In the process, that's affected E4A because that document, it gets into some of those requirements for the chief agent. So that slowed it down somewhat. Though there aren't very many mortgage insurers, we introduced my mortgage insurance capital requirements beginning of the year, which are quite different from the MCT. So we're still working our way through that. Right now, we've got a lot of things on our
little
plate.
bit of industry pushback on that one.
There's always industry pushback on capital requirements,
Yeah.
And one can understand why. You know, any change like that can be quite significant. So, and there was a lot of pushback on MCT, but we have dealt with, or not MCT, but mortgage insurance.
Yeah.
But we have dealt with the industry on it. We've made some changes. They've made some good points. So I think we're getting pretty close to having that fully resolved.
That's an interesting industry, actually, to ponder because it is one where the people involved, and I say this just as a business journalist who's seen many cycles, bubbles, asset bubbles, if I'm going to say it. I've seen many asset bubbles. And at or near the peak, the people involved are the least likely to yell fire in a crowded theater, right? They do not want anything to stop because it's feeling very good. From a regular, I'm not saying you have to agree that there's an asset bubble in parts of the housing market. Feel free, but you don't have to. But from a regulatory point of view, there is this kind of, it's a delicate dance, right? Because there are economic implications, you know, we don't want to crash anything, and yet moves like that are seen. I mean, some of the headlines when you made the insurance move were, you know, OSFI doesn't want people to buy homes, right? You're a big bad regulator. But what is the kind of delicate dance you play?
Yeah, we would only deal with the capital part for the insurance companies. The Department of Finance has gotten involved with the banks in particular and controlling how those mortgages are underwritten. And there was some concern. I mean, there's always concerns about a bubble when a market grows that fast, when the house prices are going up significantly, and when interest rates are very low and people are actually maximizing their purchase. So that creates a scary environment. It creates a potential for a bubble. So the idea was to control that better. So interest rate testing. So before someone buys a home, what would happen if interest rates rose to 4%? So they have to be able to accommodate some increases in interest rate. But it still is a very significant issue because interest rate goes up to 4% from today's rates. That would be a big increase in the carrying cost. In the meantime, the price of the house would drop significantly. So now you've got people questioning whether they want to keep it. So it's a very tricky area because people will, whether they don't always look at the value of the house when they're making their decision to stay there. So there is a good chance that people will continue to pay that mortgage even though it's painful and the value has gone down, recognizing that maybe in 20 years from now it might go back up again. You know, so it is a cyclical market, but it is a concern. And what the government's tried to do is just make sure that the bubble doesn't get out of control. What we don't want is to have a subprime market issue like occurred in the United States. And a lot of people did lose their house anyway down there. So I think we're in pretty good shape on that. We've done some stress testing, and I think it's under reasonable control. So I wouldn't say that I lose sleep over the potentials of a broken the housing bubble and bursting, but that possibility is there. So we are continually aware of it. We continually monitor it. And of course, the mortgage capital was designed to get at some of those issues as well. So in determining the cost and for the coverage, take a look at credit scores, things that under the MCT we don't even consider. Loan to value location's important. So houses in Saskatchewan oil industries are significant. So there's a different charge for that. And the reality is that actually came home to roost when oil prices dropped. Unemployment rose in Alberta, and we've had some of that experience come through. Now, it hasn't been significant enough to be a major issue, but it is rearing its head. So we know there is that correlation.
Do we have questions out here? I said I would keep an eye on you. Anybody do you have a question at the back? Yep. Is that Dawn? Dawn, way at the back? Goodness.
Good morning, Amanda.
Good morning.
Yeah, good morning, Amanda. It's Don Forgeron from the Insurance Bureau. Robert McDowell is not here, and he had me promise that I would ask a question, because Robert always asks the first question at all of these events. Good morning, Neville. Question for you about earthquake. The federal government's got a financial sector review underway, and in there they talk about the issue of earthquake, and they talk about the systemic risk posed by a large event. They also, I think, applaud the, I think I'm quoting, stringent prudential regulations that OSFI currently has in place for the sector. So my question is twofold. I think I'm trying to lead you with the first one. The question is twofold. One, any consideration at OSFI at the moment or discussion within OSFI about the current prudential rules around capital, whereas the paper notes we have some of the highest capital levels globally. And secondly, to the extent that you're able to, any comments on the issues that are raised in the paper around systemic risk?
Let's talk about capital requirements first. And when we talk about capital, we're not just talking about regulatory capital. When we think about capital, we talk about the capital available to meet all of a company's liabilities. That includes whatever reserves they've got set up and things like that. And I've heard the allegation that OSFI has the highest capital requirements in the world. And if you just look at regulatory track capital, that may be true, especially if you compare us to someplace like the United States. But the U.S. has a statutory reserve system, and ours is an ongoing reserve system. So the U.S. has very arbitrarily high reserves. When we look at the total capital required in each system, they're very similar. So I'm not entirely convinced that there's that big a difference in the capital requirements worldwide. Next year, we will be introducing life insurance capital requirements, new life insurance capital requirements, and they're quite extensive. So that's going to fill a lot of our time. Every few years, we do review capital requirements. So the MCT will come up for review in a few years, but it was redone, I've forgotten when, maybe 3 or 4 years ago. But anyway, we have no major issues with the MCT and its structure, so it will be more of a review, and certainly if any changes are proposed, as usual, we will discuss those with the industry. On systemic risk, we are constantly looking at that, and earthquake is a huge issue. At OSFI, we look at it from the perspective of modeling and what could happen if it took place. We get a sense for what the total damage could be. We get a sense for what the insured costs could be. So we have set up requirements that the industry should be able to meet. I think it's about a $35 billion catastrophe, and they're in place to do that. I think that goes up by $5 billion next year or something. So we're expecting the industry to increase that amount. But there will be a huge gap between the actual amount of claims and the covered claims, and that's a reality. And that's something that, unless there's another authority, unless there's another way of pricing that product to pick that cost up, then it's gonna be there. So I don't think I've answered your question the way you'd like me to answer. There's no clean answer to that. Hopefully, and we depend heavily on reinsurance to fill that gap. Hopefully they're looking at this issue from that perspective as well.
Is there anything that we can do to encourage that to happen? Especially on the earthquake front, the coverage gap could be if you get the once in 100 that we're 50 years overdue for on the West Coast, how do you manage the coverage gap we see there?
Yeah, you don't. It'll fall on the taxpayer to the extent that, and to individuals. So it is it could be a huge human disaster, and some of them may never recover from it. I think even the catastrophic storms in the Caribbean are having huge implications for a lot of people's lives. So it is quite a disastrous situation, and insurance can't protect against all of those. In the end, you got a depends on probability of event, but a 1 in 500-year event, for example. If it happens, the cost is gargantuan. It's a couple of $100 billion, maybe more. So how do you charge premium to cover that in 1 year? It's the sort of product you need to have an annual premium for, and you build up some reserve or something.
Yep.
It's a totally different structure. So I think there is a big challenge in that. As long as we continue the way we're going, then it's really the reinsurers that diversify the risk and hopefully make a decent profit from it, although this year it doesn't look promising.
Any other questions out here? Yep, right here. Oh, I'm going to start here and then I'm going to come over here. Yes?
Good morning, Mr. Henderson. I'm wondering if you could expand on your comments regarding the two forms of risk assessment that the industry completes. Right now we have DCAT and we have ORSA. And you mentioned the conflict between those assessments, if I heard you correctly, and some of the troubles that the professional colleges may be dealing with both assessments.
Yeah, there's not a conflict. They were actually designed to do different things. DCAT was brought out, I was president of the Institute when we brought it out, and I've forgotten when that was. But anyway, it was brought out to help with the valuation of liabilities and to make sure that going forward, the company would have enough capital just to stay solvent. So it was really linked to that part of the business. And the actuary has to sign an opinion to that effect, and it's written into professional standards. It's also written into the Insurance Companies Act. The actuary has to do that. The appointed actuary has to sign that, make that statement. There's also requirements around presenting the DCAT to the board and to senior management. So all of that, with the introduction of ORSA, if we were to turn that into ORSA, we'd have to make changes to all of those requirements. ORSA doesn't really address the stress testing in the same way that the DCAT does. So that actually that's fixable, and the Canadian Institute of Actuaries is working on that. But in order to get rid of one or the other, we're actually going to have to change professional standards. We'll probably have to make some changes to the Insurance Companies Act, et cetera. So it's just it's the total amount of changes that need to be done to accommodate that change.
We've got a question right here.
Neville, I think I heard you saying that about IFRS 17 that OSFI might have to undo some part of it depending on the results it produced. So my question is, how do you foresee a reasonable time frame for these changes to occur in the next years? And maybe as a sub-question, how do you see the capital requirements versus maybe the new liabilities that will be established with IFRS 17?
Well, we're very worried about bringing it in, and we know it's going to be a big change for the industry. And we really don't have a way of knowing what the total impact could be without dealing with the industry. So we've structured an internal committee, and we do have continual meetings with the accounting profession to get a sense for what those changes might be and how they might affect capital. We're actually going to be dealing with the industry on that. And if when we get towards the end, if in fact it does affect capital, we'll have to figure out, in a way we don't want it to change capital, we'll have to figure out how to deal with that. And we have done that in the past. We did it on deferred acquisition costs. I think it was deferred tax assets. We did it on the life side. So there are some things we can do to address those issues. We might even have to relook at capital to change it. If there's a sudden increase in capital requirements for no apparently good reason other than accounting, we're not going to force that on the industry. So we'd have to figure out how to accommodate that.
All right, we're at time, so I'm going to ask you, just what would you want the people in this room, leaders from across the spectrum of the industry, to be thinking of? What should be top of mind for them?
I think they probably are already thinking of it. You know, it is a very dynamic industry. I think we're going to see rapid change, and I think we just have to be prepared for it. The ultimate beneficiary of your products is the policyholder, and I know that there's a lot of concern about servicing policyholders and taking care of them. Our concern is just making sure there's enough funding to pay those policyholders when the claims come due. So, you know, I think it's that forward thinking, looking for alternatives that the industry needs to continually focus on.
Please join me in thanking Neville Henderson.